Do you know how many companies are listed on stock exchange? Well, 5,000 plus on Bombay Stock Exchange. And how many companies do the most successful investors have in their portfolio? In fact, even 5 potential companies with good capital deployed can make you rich. So, many of you might have wondered what criteria is used by the most successful investors to filter out the limited stocks for their investments. Well, here in this video, I am going to tell you about one of those many criterias, that is PE ratio. In last video, I have given you just a brief introduction. Here we will see in more detailed way. The price to earning ratio is equal to current market price divided by earnings per share. Here the term in denominator, which is earnings per share or EPS, is the amount of profit that company is generating in a year per share. Formula for EPS is net profit divided by total number of shares. Let us understand with an example. There is company called MNC Limited. You can consider any company which is listed on stock exchange. Suppose the last trading price or the current market price of the share is 500 rupees. The company's net profit after tax is 5 crores and the total number of shares are 50 lakhs. Therefore, EPS is equals to profit after tax, which is 5 crores in this case, divided by number of shares, which is 50 lakhs, which comes out to be 10. That means for every share the company is generating 10 rupees as profit. Now price to earning ratio for MNC Limited can be calculated as current market price, which is 500 divided by EPS, which is 10. Therefore, the price to earning ratio for MNC Limited is 50. Now I am adding 2 more questions to this example to have better clarity. Firstly, if the company's share price changes from 500 rupees to 1000 rupees, what will happen to the PE, assuming that its profit remains constant as 5 crores? It will be 100, which was earlier 50. Secondly, if the company posts double profit, which means it generates 10 crores as profit, which was 5 crores in earlier case, what happens to the PE assuming that company's share price remains constant as 500 rupees? EPS in this case will be 20, which in turn gives PE ratio as 25, which is exactly as half of the previous case, which was 50 earlier. If we observe closely, it is understood from the above examples that PE ratio changes as the share price changes, or it changes as the earnings of the share changes. It is considered as the most popular parameter while deciding the valuations. This ratio tells you whether this particular stock is undervalued or overvalued. It also tells you how expensive or cheap the stock is with respect to its true value. But the real question still remains the same. How? Please understand that there is no such value as low or high PE ratio. You just need to compare that stock PE ratio with that of corresponding sector or with its peers. PE ratios can be as low as 1 and as high as over 1000 as well. The companies having higher PE ratios than that of corresponding sector PE, not necessarily, but has higher probability of being overvalued. Similarly, the companies having lower PE ratios than that of corresponding sectors, not necessarily, but has higher probability of being undervalued. Broadly speaking, there are 2 types of PE ratios, forward PE and trailing PE. Forward PE calculates the value predicting the immediate future quarter results, while backward PE calculates the value based on actual past quarter results. Sometimes a stock can be overvalued because of its bright future growth prospects. People might be willing to pay higher premium values in present because they might believe that the company might perform better in future, because people have more faith in the business model of that company. Now, suppose the company doubles its profit, then PE will be half. Please note that PE ratio should not be used as the only criteria while selecting the stocks. You need to look at the other parameters as well, such as price to book value ratio, debt to equity ratio, operating profit margin, return on capital employed, CAGR, that is compounded annual growth rates for sales, profit, etc. You need not to calculate each time the PE ratios for every companies. There are a number of free websites like Money Control, Screener, and many more, which will directly show these values. Sometimes PE ratios for certain companies might not be available anywhere. There can be 2 reasons behind this. Either the company might be in loss, and other being the non-availability of sufficient data, which can happen in case of newly listed companies. So the conclusion is to buying the stocks which are undervalued and selling it when it becomes overvalued. In future videos we will learn about other parameters as well. I hope you enjoyed watching the video. Please like, share and subscribe to the channel. Thank you.